Welcome back here to Mountain Connections. As I mentioned earlier, tax season is still quite a ways away, but if you're very smart about your taxes, you're thinking about them now in ways that you can plan your year-end taxes to minimize your tax burden. Here with us, we have our really good friend, Blake Christian. He's a tax partner over at Holt House, Carlin & Van Trick, here to give some great year-end tax credit information. How are you doing today?
Doing great.
To see you, Blake.
Good to see you, Diego.
Always a pleasure to see you, sir. So tell me a little bit about the biggest things people need to think about as the year is coming to a close and they're getting ready for the upcoming tax season.
Yeah, so virtually all individual taxpayers are on what we call a cash basis. So you need to cut checks, or you can put it on a credit card, any of your deductible business expenses by year end. You can do some things after year end, but for the most part, you need to tidy up your personal books by the end of the year by cutting checks. And again, a lot of people don't realize it, but putting it on a credit card, even if you don't pay it off by year end, can be a deductible
Can
expense.
still be deductible, which is huge.
So
There's some big things if you need to tie up some loose ends towards the end of the year.
You're already late if, in Utah, if you haven't paid your property tax, but, get those in. Paying, you can prepay your mortgage interest a little bit.
Okay.
If you have rental properties, pay off, if you have a property manager, pay them in advance, pay off any December amounts, all of those types of things.
And these are all things that you can write off for next year's taxes to minimize.
You can even prepay your CPA.
Really? There's a
Right.
Prepay your CPA and you can write that off. That's a huge one as well. Let's also talk about some charitable contributions and timing those out so that they are the most effective as well.
Right. With the 2017 Tax Act, a lot of middle income and certainly lower income people, they're not allowed to itemize anymore just because they don't get above the threshold. You can't deduct your state and local tax, or it's $10,000 limit on your property tax and your state income tax. So a lot of people are not itemizing anymore. So what a lot of our middle income clients are doing is they'll double up on their charitable contributions in some years, spike their itemized deductions, and then maybe lay off the next year and go back to just the standard deduction.
I see. So that's another great way there. Let's also talk about Roth IRA accounts, which have been for a long time and continue to be a very effective tool in retirement planning.
Right. So the bad news on a Roth IRA, or you can also do a Roth 401k through your employer. Most give you the option of either doing a deductible regular 401k or a Roth 401k. And the great thing about that is you could be making $1 million a year and you're not phased out if you put it in a 401k. On an IRA, on the other hand, once you hit a couple $100,000 of taxable income, you can't put money into an IRA or a Roth IRA. So you don't get a front-end deduction, but after 5 years, the accumulated appreciation in that Roth IRA is tax-free.
Excellent.
Now you may get penalized for pulling it out before you're 59 and a half, but once you're 59 and a half, it's been in there 5 years. You could have started with a couple $100,000, it could be $1 million. That $800,000 never gets taxed.
Wow, that's fantastic.
Right.
A great opportunity there for people as well. What are some other big tips that you give to your individual taxpayers that are preparing for the season as the season closes? Right.
Well, you definitely want to be, as we talked about, you want to be fully funding all of your retirement accounts. And a lot of those, an IRA can be set up and funded by April 15th. Simplified employee pension plan can be also set up after year end, and you can put up to a little over $50,000 into those if you have self-employment income from a business. And then what we're doing a lot of this year is really doing customized pension plans. We don't set those up, but we work with actuaries to set those up. And those you can put, a 50-year-old person can put in, under the right circumstances, $200,000-$300,000 a year into those.
Wow.
And because there's such a short period before they get into retirement. And so that has several benefits. Number one, you can really accelerate your retirement funding. Number two, you get a massive tax deduction. Number three, if they have a business, which normally they would to get that deduction, you trigger what's called under Section 199A, the qualified business interest deduction.
Interesting.
On a flow through, an S corp or a partnership, you get a 20% right off the top deduction.
Wow.
But if your income is over $425,000 as a married couple, it phases out. So if you put in these big pension plans, you lower your adjusted gross income. And we just did a calculation the other day. By creating a $100,000 pension deduction, we were able to trigger an extra $36,000 of 199A. So the government is funding even more of their pension plan.
Wow, that's amazing. That's
but
amazing.
that all has to be done by year end, or you're toast.
Or you're toast. So these are some very important things to be thinking about as we're approaching the year end. Something else that we want to talk about briefly is the Qualified Opportunity Zone. And for those who aren't familiar with the Qualified Opportunity Zone, just give a brief description of what that is.
Right. So if you have a large capital gain, it can be from anything. You can sell a piece of real estate, you could have sold your business, you could have sold Bitcoin, you could have sold a collector car.
Okay.
Any capital gain that you've realized in the last 180 days, that can be rolled in to a qualified opportunity fund. And just by simply rolling that into it, and you don't even have to do that by year end, you just have to do it within 180 days, of getting the gain. You defer the tax on that until 2026. So you get a 7-year deferral.
Wow.
For federal and state here in Utah. There's only 4 states that didn't adopt it. And then in 2026, if you've held it for 7 years, you only pay tax on 85% of the gain.
Wow.
That's that in of itself is pretty nice, but the exciting part happens after 10-year hold. The appreciation in that fund from the time you invested the money is tax-free.
Wow.
You never pay tax.
That's huge.
Right.
That's amazing. And that's specifically why you were calling this the most valuable and impactful U.S. tax incentive program enacted in this century.
Right.
Which is huge.
Right. And I would say actually in my entire career, 39 years, there's nothing even close. It's so flexible.
That's great.
We've set up 25 for clients. They're being set up all over the country.
Some of the most effective tax planning.
The press is bashing them a little bit, but I think that's more of the Trump effect.
It's more of the emotional aspect tied to it rather than
they're really developed under the Obama administration, but just passed under the Trump. But everybody's doing these. It's huge.
Before we get out of here, I do want to highlight, you just wrote a book on opportunity zones that people can pick up on Amazon. I do want to highlight that really quickly. Where can people find this book? What's the name?
Right. You can order it on Amazon, and it's How to Oz.
How to Oz, a guide to opportunity zones. This is really big for anyone wanting to take advantage of these qualified opportunity zones. Where can people go to find out more information about Holthaus, Carlin, and Vantricht?
Right, so our website is hcvt.com, and then our phone number is 435-200-9262.
Excellent. Thank you so much, Blake. Really appreciate
you
coming in and giving some amazing end-of-year tax planning advice, as well as some tips about qualified opportunity zones. Head to their website to find out more information. And if you want to learn more about qualified opportunity zones, pick up Blake's brand new book on Amazon, How to Oz. We'll be right back with much more right here on Mountain Connections.